Hello and welcome everyone. Thank you very much for joining us today on this webinar, Deal Making in Uncertain Times, where we will take a deep dive into the second quarter and the first half of 2020. My name is Mahmoud Khalifat and I'm a Director of Market Development for our investment banking business in EMEA. And I will be your host today. I am joined by my colleagues, Matthew Toole, the Director of Refinitiv Deals Intelligence, and Lucille Jones, an analyst in the Refinitiv Deals Intelligence team. Before we begin, let me cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom or on the left side of your screen and submit your question. I would like to encourage everybody to submit as many questions as you can throughout the webinar, and we will try to get to as many as we can. We will be sending you a recording of the webcast as well as a copy of today's slide deck following this presentation. So in case you have any issues, rest assured you will get up the presentation and you will get a recording. Finally, and before we start, we would like to learn a little bit more about our audience today. So we have the following questions, which we would appreciate your answers to. The first question is, please tell us which region do you work in? Americas, Europe, Asia Pacific, and Japan, Middle East, and Africa. Just simply click on the answer that is suitable, submit, and we will see the results in a few seconds. Okay, thank you very much. Our second question is, please tell us which function do you work at? Are you in M&A, ECM, DCM, general coverage, or any other function? Thank you so much. Last time we hosted this webinar, most of the world was in lockdown, with unclear roadmaps as to how and when to emerge from it. One thing we learned back then from Lucille and Matt, that a 7-year corporate finance boom came to a sudden halt. Today, markets and deal-making are faced by further uncertainty, even as countries ease their lockdown measures and governments put together significant and large stimulus plans. Before I turn here to Matt and Lucille, who will tell us how the lockdown quarter looked like from a deal-making perspective, allow me to ask one other question. We would like to learn more about your sentiment for the second half of the year. And so let me ask you, which investment banking product you feel will be most severely affected by the COVID-19 pandemic in the second half of 2020? Thank you very much. It's interesting. 47% is M&A, 28% equity capital markets, 19% for debt capital markets, and 6% for syndicated loans. Just as a reminder, in our previous survey, very similar, 45% of the audience thought M&A would be hardest hit, followed by equities at 31%, very similar, DCM at 15%, and 8% thought the syndicated loans will be hit. Let me turn here to Matt. Matt, off to you. Could you please tell us how the lockdown quarter looked like?
Sure. Thanks very much, Mahmoud. And thanks, everyone, for joining us today. So starting off, kind of looking at the high-level picture of the quarter and the first half, starting out with global investment banking fees. We've come off of the second quarter. We now have kind of the full historical view of what occurred. And I think, for many of us who've been watching the market, the second quarter was a complete change from where we had seen over the last 7 to even 10 years from an overall product shift perspective. From a high-level perspective, overall global investment banking fees totaled just over $57 billion in the first half of 2020, which was an all-time record. And that's up 9% compared to a year ago. But the overall product mix and the overall regional mix is changing quite rapidly. And so you can see on the left-hand side of your screen, that yellow bar is the percentage of, or the overall dollar value of debt capital markets fees, which has really been the story of the second quarter and really kind of the post COVID-19 investment banking story is kind of how powerful the debt capital markets have been, and we'll get more into detail into that later in the webcast. But the overall effect that it's had on the overall investment banking pie has been kind of unprecedented here. From a regional perspective, you can see that the Americas still the overall majority of investment banking fees across all products, and that has continued to climb since the lows of the financial crisis. And then Europe and Asia Pacific have really changed over time. The fee pool coming out of Asia, particularly driven by China, is set to eclipse Europe at some point. And in some quarters it has. You can see it's been a bit rocky for European investment banking fees and the overall contribution. But I think it's interesting to see just how that rise has continued and how the overall percentage coming from Asia Pacific, and again driven largely by China and the China capital markets activity that we've seen, is really kind of been a hallmark of this year, where it might actually at some point surpass the overall European percentages. From an overall product perspective, as we talked about, M&A activity, which has been the driver of the last number of years of activity, was down 15% during the first half, and then loans was down 10% as most of our debt capital markets products had shifted to the bond market. And so bond fees were up 31% compared to a year ago, equity fees up 38% compared to a year ago. And if I take it to the monthly view, this is kind of the overall monthly view of overall investment banking fees. And you can see the high point in March 2017, which was really the point where almost all of our investment banking products were working kind of at full cylinder. So the bond market, certainly the U.S. corporate bond market was healthy, helping to finance record M&A levels. Equities and IPOs in 2017 also at very healthy levels. And so that was the peak there. And so, we are a little bit off kilter as far as the percentages and the contributions coming from each. But you can also see the month-over-month changes. And so that March 2020 number is really where everything paused and then strongly came back in April and May, really driven by DCM. And looking particularly at DCM, you can see kind of here the 20-year time horizon of debt capital markets, really driven by that U.S. corporate bond number, but reaching an all-time high in the second quarter. We saw record levels of activity, both by number of issuers as well as the overall proceeds raised, and that has obviously brought itself right into the overall fee pool, which I expect we'll see as investment banks begin to report earnings in the next couple of weeks. Those investment banks with very strong debt franchises will see particularly strong second quarter and first half numbers. And we'll pass it back to Mahmoud.
Thank you, Matt. One of the themes that we always focused on in this webcast is boutiques versus the bulge brackets. In fact, in a recent article, the Financial Times featured our figures, reference figures and analysis in an attempt to discuss the prospects of this independent M&A sector and the independent M&A advisors, especially post what it called the land grab in the aftermath of the financial crisis. So let me ask Lucille here, how did they fare in the second quarter versus the large balance sheet driven banks? Especially, we heard just from Matt that debt was very heavy, capabilities to underwrite were very important. How did these guys fare?
Hi, Mahmoud. Thanks. It was a great article at the FT earlier this week So if I just switch to the next slide. So here we're looking at global M&A advisory fees earned from completed M&A transactions during the first 6 months of each year going back around 2 decades. And we can see how boutique and independent firms have really challenged the more traditional investment banks in this space. So fees earned by boutiques are shown in the blue portion of the bar, and the grey part shows the remaining fees earned by non-boutique firms. And we can see that these small shops have made some real inroads over the past decade or so, peaking in 2018 when they saw combined fees earned by this group quadruple in value, actually, from those earned during the first half of 2009. So real inroads made over the last decade, offering focused expertise, dedicated personnel, specialised services, and arguing that they are free from the conflicts of interest that may be found in some of the bigger banks. Boutique advisors didn't just earn more fees with the growing fee pool, but they actually grew their share as well. So if we look here, pre-financial crisis, they earned around 20% of the M&A fee pool, but this has grown to between sort of 35 and 40% over the last 5 years. So these boutiques, many led by bankers who left global banks to strike out on their own, they really thrived in the wake of the financial crisis. However, the recent downturn in M&A could shake things up a little bit. We already saw that M&A advisory fees have fallen 16% from last year to the lowest first half level since 2014, so 6 years. Looking at fees and specifically by boutiques, we can see a similar decline. So we estimate that boutiques earned a combined $4.9 billion in completed M&A advisory fees during the first half of 2020, and that's down 14% from 2019. And the second consecutive year-to-date decline after almost a decade of growth. On a positive note, if we look at the percentage earned by boutiques, we can see that they are holding on to their share. So they're at 38% during the first half of this year, and they're only just behind their all-time high of 39% in 2018. Now the orange line shows the wallet share of the top 5 banks, so that's Goldman Sachs, JP Morgan, Morgan Stanley, Citi, and Bank of America. And these banks have also seen a decline in M&A fees from last year, but only 3%. So as a reminder, the boutiques saw 16%. So the top 5 banks have seen a decline of 3% this year. So they've actually grown their share to 34%, and that's up from 29% last year. And it's the highest combined group share since 2015. The big global firms can be more attractive during tough times. Companies may be sort of more inclined to foster their relationships with the big banks because they're able to extend much needed financing through times of crisis. But for all players, the size of the fee pool appears to be shrinking with declining M&A levels, and we'll talk about that a little bit later on. So as deals dry up, it begs the question, what do these specialised shops do? How do they make up for their losses of, lucrative fees from M&A deals? Unlike the global banks, they don't have other divisions, the trading, the capital markets business that can pick up the slack when M&A activity is down. They are a lot more exposed. Some of the specialised independents that focus on particular sectors or regions could be very hard hit. Some firms have already switched their focus and adapted to serve clients who are facing different challenges, so helping companies to restructure and navigate the crisis. So it will be interesting to see what happens in this space over the coming months and through the end of the year. I guess winners and losers here for sure.
Thank you, Lucy. It's certainly very interesting. And as you say, probably a little bit early to pass on judgment, but it sounds like that independence bit, along with that agility to switch into restructuring and other products, might give the sector lifeline. And let's see how they fare throughout the year. Certainly depends on the the length of this downturn. I am itching, and I'm sure the audience is, to learn more about any geographic divergence. So let me ask the question here. Which region or which region's deal making you think will see the most disruption due to these uncertain times in the second half of 2020? So I'd appreciate if the audience can hit, which answer you feel is most suitable. Give you a few seconds. And let's take a look at the results. So 42% believe it's the Americas that will continue to suffer in the second half, 24% Europe, 12% Asia Pacific, 20.5% for Africa and the Middle East, and only 1.2% for Japan. That's quite interesting, because in our last survey, 48% thought, and rightly so, it sounds like the Americas, followed by 29% for Europe, 12% for Asia Pacific. So Lucille, as I said, we're all itching to know about any geographic diversions and how did it look like? Over to you.
Thanks, Mahmood. On the left here, we have just over 20 years of first half announced M&A volumes, so that's January to June. And on the right-hand side, we have a quarterly view of M&A activity. And you can see the elevated levels and the recent decline. So 1.2 trillion worth of deals were announced globally during the first 6 months of 2020, and that's down 41% compared to last year. And it's the lowest first half total since 2013, so 7 years. By number of deals, global M&A has fallen 16% to a 6-year low. Breaking that down into quarters, the second quarter of 2020 registered a 25% decline compared to the first quarter of the year, and it actually marked the slowest quarter for deal making since the first quarter of 2012. Deal makers actually started the year with a very positive outlook, expecting M&A to increase. We ran a deal maker sentiment survey at the end of last year, and there was a lot of optimism. But one of the biggest concerns by respondents was an unforeseen economic event. And then came the coronavirus pandemic, bringing with it, a time of extreme uncertainty for the global economy and for the outlook of most companies. And you can see the impact that it's had. M&A stalled as deal makers had to reassess how to get deals done and what business models look like and what valuations look like. Regionally, just look at the US, the blue line, a very sharp decline. M&A declined almost 70% from last year to the lowest first half level since 2012. The second quarter was actually the lowest since the first quarter of 2003, so more than 17 years ago. While the value of deals fell 70% from last year, the number of deals actually only dropped 13%. And this is because, there's a lot of big ticket M&A deals that come out of the US, and it's these announcements that have been particularly affected by the downturn. Moving to Europe, that's the orange line here. It's been a 37% increase in the value of M&A from last year, which is, surprising. It actually exceeds the US for the first time since 2012, but the figure here is heavily propped up by 5 of the largest deals of the first half, including a very large 107 billion dual-headed share unification for Unilever. So heavily propped up that figure. The region has actually seen a 31% decline in the number of deal announcements from last year to actually the lowest first half tally since 2004, for 16 years. Moving to Asia Pacific, that's the yellow line. The value of M&A has declined 8% from last year to the lowest first half total in the region for 7 years. The number of deals declined 17%. We actually saw a very small uptick in the second quarter, but year on year we are down 8%. It's so interesting here to see the interplay between the US, Europe and Asia, and how much of an impact the different regions have on M&A activity historically. The composition of the regions and the growth of Asia Pacific over the last 10 years shows a much more sort of interconnected global market compared to 10 to 15 years ago. And the composition so far this year is really something else. We've got Asia Pacific accounting for more than a quarter of worldwide merger activity, up from 16% last year. And then the US, which accounted for over half deal making last year and regularly accounted for over half of deal making over the last few years, is now down to less than a third and is exceeded by Europe. So, yeah, very interesting here. So Mahmood, I think the audience poll, they were quite right to expect that the US deal making would see most disruption. So here we're having a look a bit further back. So this is a 40-year look at the M&A cycle. This most recent M&A cycle was the longest that we've seen since we began tracking M&A in 1980. The red or orange bars here are recession periods. So you can see a pretty dramatic decline in the number of deals during these periods. Often the headlines are driven by the big consolidations, the big ticket deals, which they've really been the hallmark of the past 7 years. But the number of deals is also a real key indicator of the health of M&A. It's the mid-market. So for the last 3 years, we've had in excess of 50,000 M&A transactions announced each year globally, and only around 100 of them are the large cap, headline-grabbing M&A deals that really drive value. If you look at the sort of peaks and the troughs in each of the recessionary periods, 2000 to 2001, we saw a 21% decline in the overall M&A activity by number of deals to this point, and then another notable drop in 2008, 2009. Currently, we're down 16% in the year-to-date 2020 time period, with a pronounced drop in activity in the second quarter. We haven't technically come into a recessionary period, but we certainly expect that will happen, looking at the current economic environment. So, yeah, it's interesting to see the hallmarks of these times and also the regions that have been impacted. In 2000 to 2001, it was a relatively US recession, and much of the activity that was generated in the dot-com boom and then bust was in the US, whereas the financial crisis in 2007, 2008 was a much more global phenomenon, and I would argue that 2020 will also be sort of a global. So, yeah, really interesting to see the historical numbers here. Moving on. So now we're going back to a regional view, but this time we're looking at monthly activity across the different regions. And I think it's really important this year to look at the monthly numbers. So we saw earlier, for example, that M&A in Europe is up nearly 40% from last year. But it really doesn't give the full story. You need to take a look at the monthly numbers, and it also helps as well to split out the mega deals to give you a clear picture. So the year started well, with January and February seeing pretty healthy levels of global deal making, but then M&A plummeted at the end of March and into April and May. So just 100 billion worth of M&A deals were announced globally during April, and that's the lowest monthly total since September 2004, so more than 15 years. We did see an uptick in May, but still well below what we've become accustomed to in recent years. We saw further pickup in June. At 260 billion, it was more than double the value recorded in May, but the value, again, was propped up by a couple of very large deals. So the grey portion in all of these bar charts represent the mega deals, so the deals valued at $5 billion or more. And in the US, In the US, we'd already seen a bit of slowdown in the first quarter before COVID really hit, but you can see the sharp decline in April and May. So April was actually the lowest monthly total since February 2009, more than a decade. In Europe, M&A is, as I said before, up almost 40% from this time last year. We had some very big deal announcements in the first half, which masked sort of a broad decline in M&A activity. M&A involving European targets totaled just 14 billion in April, and that was the lowest monthly total in more than a decade. And actually, if you look at the UK, there's not a chart here, but in the UK, April saw the lowest month for M&A activity this century. So you actually have to go back to the 90s to see lower levels of deal making in the UK. We did see an uptick in May in the UK and in Europe as a whole, propped up by O2's Open Media deal, but the number of deals remain low. So in Europe, we're looking at around 700 a month compared to well over 1,000 each month throughout last year. And then moving to Asia on the right, in yellow, they saw a sharp decline in M&A right at the start of the year. They were sort of ahead of the West in terms of the pandemic, and they seem to be recovering a little bit better. April was only 3% down on April 2019, and May was only 8% down. June levels were down a little bit more, but not dissimilar to last year. So they certainly appear to be ahead of the West in terms of recovery, and they also seem to be a little bit less affected by the presence or the lack of mega deals. Moving to again looking at larger deals. So here, deals valued at $1 billion or more. Just 10 deals worth $1 billion or more were announced during April, and that's compared to 56 in April of last year, and it was the lowest monthly number of deals in this size category in the last decade. We actually didn't see a single deal worth $1 billion or more globally during the second week of April, and that's the first time we've seen this kind of global shutdown since September 2004. And in Europe, we had 4 consecutive weeks without a $1 billion deal. So announcements of deals which have really driven M&A over the past few years have just paused. We saw a slight uptick in May, and then again in June. June saw 30 deals, which is, it's an improvement, but it's considerably down compared to last year. So companies showing little appetite to execute large mergers amid a global pandemic. What happened to these deals that we would have expected to see in April and May? The deals that were in discussion but hadn't been announced before COVID. Some of these may be on hold. We may see more announcements towards the back end of the year where there's a bit more clarity around the virus and how it's affected the economy, but others just might not make sense anymore. One thing worth mentioning here as well is that deals are taking longer to complete right now. A couple of weeks ago, we were looking at mega deals worth $5 billion or more, and they are now taking an average of 233 days to complete this year, which is an 18-year high. So I guess not surprising with all the travel restrictions and regulatory hurdles. The path from announcement to completion is tougher now than it was a few years ago. Now for a look at cross-border M&A. So we saw real growth in activity for around 5 years, from 2014 to 2018. And during this time, we saw Chinese buyers move quite aggressively into this space. And cross-border deals accounted for around 40% of global deal making. And then last year, corporate deal makers stayed a bit closer to home. Cross-border deals started to dry up amid trade wars and rising protectionist sentiments. Inward investments to the US and the EU were coming under increased scrutiny. and political intervention. It wasn't the most hospitable environment for cross-border deals. We saw a big decline in Chinese acquisitions, and transactions became more local in nature. We had some really large US domestic deals at the start of last year. Let's see where we are now. We had 440 billion worth of deals announced in the first 6 months of 2020, which is down 15% compared to last year and the lowest year-to-date level since 2013. The number of deals declined 24% to a 7-year low. Less than 30 billion worth of deals were announced during the month of April, and that's the lowest monthly total in over a decade. May levels were also depressed. And then you have this spike in June, but again, June was boosted by a couple of very large deals. I spoke earlier about our dealmaker sentiment survey, and the survey that we conducted at the end of last year before COVID. And there were a lot of concerns at this time around protectionism, trade policies, trade wars, and these still exist. And now there are real concerns that the virus could leave some companies open to hostile foreign takeovers. In April, we saw the likes of India introduce measures to protect against foreign, particularly Chinese investment, fearing that some of their companies might become easy prey as their share price declines. And then in Europe, the EU competition chief urged European companies to actually pursue cross-border takeovers within the bloc to ward off opportunistic foreign buyers that might try and swoop in and grab up companies that have been left a bit vulnerable by the drop in market value. So again, very interesting to see what happens here over the coming months. Mahmood, back to you. I believe you have another poll for us.
Yes, thank you very much, Lucille. Very interesting insights. Let us turn to industries and see if there's any industry divergence here. We've seen the markets recover despite continued volatility, and it continues as we see it day in, day out. For instance, the Nasdaq stands at levels higher than those seen before the lockdown back in March. Back in April, when we had this webinar, our audience thought retail and consumer will be negatively affected, while tech and healthcare could see a more positive outcome, or what we called back then a reimagination of their models post this crisis. So let me turn to the audience another time and ask the following question. Which industry will be most negatively impacted by the disruption in deal making due to this crisis we're in? I'll give it a few more seconds because it's a long list of industries that we have here. So it sounds like retail is in the pole position with 27% of the audience thinking it will be negatively impacted. Consumer product and services, again, it's 12.5. Energy and power at the same level. And then followed by financials. And then we have the industrials and healthcare. Quite interesting. So let us ask you, which ones do you think will be positively impacted by that reimagination of its business model, and any consolidation that you think will happen in there? So again, back to the audience. Okay. Healthcare, 31%. People think it will be positively impacted. Media and entertainment is at 17%. Technology at 33%. Telecom is at 14%. So all in all, Matt, it sounds very similar. People haven't changed their minds. Consumer and retail to be negatively impacted. Tech and healthcare sounds like they will really benefit from a reimagination of their models and consolidation. Let me turn to you. Any clues in the data from the last quarter?
Sure, thanks. And I like ending on a positive note on the reimagination sector, because so many of the numbers this quarter have been so drastic to see as we look at the historical milestones. And so here is an overview of overall M&A for the first half of the year by industry. And I think looking at healthcare, which was the leader in 2019, and that does account for a lot of the year-over-year comparisons, because we had Bristol Myers and Celgene merging for over $90 billion last year. So the year-over-year comparisons, particularly for the U.S., are certainly affected by that, and you can see the overall comparison with healthcare right in the middle of the screen here. But all of the industries that we saw, with the exception of consumer staples due to the Unilever dual-headed share reunification, all of the sectors in the first half of 2020 saw a double-digit decline by value. And that shouldn't be surprising, as Lucille just walked through kind of all the key dynamics happening in the world of M&A. I will say, interesting to see technology on the list of kind of the positively impacted sectors, which I think makes a lot of sense from an overall strategic perspective, and seeing how technology has had a larger role. By number of deals, technology deals were down just 7% compared to a year ago, and so that's a really important indicator of the kind of the overall health of the M&A kind of practice within certain sectors. And so looking at the number of deals compared to the value, as I said, there could be one large transaction that really changes the value story, either up or down. But the number of deals and just the sheer kind of activity within the mid-market and the kind of the low, the lower activity or even private transactions is a really important indicator there. But looking at the overall industries, financials leading the way so far in 2020, followed by industrials and technology in the third spot. And there are some different dynamics that are happening here. And so if we look at the kind of the list of top deals so far this year, you'll see a number of certainly familiar names, but not a lot of the transactions right now that we're seeing in the top are really kind of strategic M&A. So there are some transactions like Unilever, which does count as an M&A transaction, as the overall kind of cost of the overall ownership profile of the company has changed. But you see this Sberbank deal in Russia, which is very similar to last year's transaction with Saudi Aramco and Saudi Basic Industries, looking at kind of some of the interplay between sovereign wealth and financial industry, so some government-related activity, and then a number of spin-offs as well. You see some spin-offs coming in with Otis Elevator and UTC Climate Controls. That's really driving up the industrials number, which is the second largest industry so far this year. And so that's really certainly the hallmark of the downturn, where some of the M&A transactions are not traditional classic combinations of two kind of major players in a particular sector. We have Willis Towers Watson and Aon, which was announced right before kind of the lockdown kind of came across the world. Certainly E-Trade and Morgan Stanley, right before, and in the financial sector as well. But I think this is something that we're trying to kind of really try to watch and try to kind of look at the core M&A activity and where that's happening in certain sectors. And right now, there is some activity. Certainly we've seen some activity in the the home delivery and food delivery space over the last couple of weeks. We saw Warren Buffett step in and have one of the largest deals in a while. So certainly some opportunities for buyers in the market, as valuations do seem to be coming down a bit. But looking for kind of all those charts that Lucille kind of walk through, when you start to see the uptick in the number of deals, and certainly within sectors, but then also when you start to see consolidation, with kind of some of the bigger players in the sector, it's an important thing to look for as we move into the second half of the year. Speaking of kind of buyers, I think one of the natural discussions that that comes along during downturns is looking at the world of private equity and kind of what role private equity can play in in the deal making environment, and really for the last 7 years and this most recent M&A cycle, private equity was oftentimes priced out because there was so much strategic activity happening, and there's obviously so much more value that can come potentially from two companies merging, and obviously the financial kind of equations for private equity obviously is very specific. But we have seen overall and most recently yesterday with KKR making a $4 billion transaction in the insurance space. We are seeing private equity come into the market. During 2020, private equity accounted for 17% of all M&A, and that's the highest percentage of M&A since the financial crisis, since 2007. And the deals are in the mid-size range. There's not kind of the blockbuster transactions that we saw in 2007, and you can see on this chart, just the sheer volume and value of transactions that was happening at that time, and the large consortiums that were all taken private. But some really strategic activity happening with private equity companies buying through their portfolio companies and rolling a couple of kind of like companies together. And also as companies are assessing their balance sheet and also their kind of the way that their business models looking, there might be some areas to dispose of some non-core assets, or some areas that private equity might come in. So the overall decline was 24% compared to a year ago, but there is some. It's obviously better than the overall industry. But last year was also the largest year that we have on record for buyout funds raising capital. So the full year of 2019. And so, seeing that capital put to work, obviously the financial, kind of activities within the corporate bond market are very favorable, as we talked about with fees. And so, for private equity companies looking to come in, particularly with valuations dropping, I think that's going to be a big story. And of the second half of the year. Warren Buffett, although is not technically private equity, we kind of look at some of his activities and seeing him step into the market with a big transaction. He's been kind of quietly complaining that there haven't been deals for him to do because it's just been too expensive. And so for him to step in just over the weekend, and then obviously private equity also kind of stepping in at a faster pace. And so looking at some of those large private equity names and what they do over the second half of this year, I think will be a really important part of the story and what that means for deal making in general. So I mentioned the capital markets, and so wanted to kind of walk through briefly the outlook and kind of what's been happening for overall equity and debt capital markets. And my overall theme for since March has really been kind of capital markets to the rescue in many sectors and in many regions. And so overall we saw a really kind of frenetic pace of activity, and you can see on the right hand side of this kind of large chart for equity capital markets just the uptick from a monthly perspective, both in the number of deals and also from proceeds. And I think companies are certainly, and CFOs and treasurers are certainly looking at the capital markets as ways to work through this crisis, but also take some opportunities in monetizing certain stakes, and we saw a lot of that happening within the equity capital markets as well. In June, we saw a record number of follow-on offerings by the number of offerings, and so oftentimes when you see these huge jumps on the right-hand side of this, by proceeds, it's some really big transactions that are pushing that volume. And so we did have PNC and BlackRock monetize some of this. PNC monetized its stake in BlackRock. We saw SoftBank take out some money from its holdings within T-Mobile, all related to potential so obviously COVID and the response to the pandemic, but those were really large transactions. But we also saw over 500 follow-on offerings in June. So the number of companies coming into the market at this point is also at a record. So when you see the number as well as the value kind of pushing those things, it's certainly something to take note of, and looking at the overall themes there. The IPO market, obviously most affected by kind of uncertainty, and we have seen some IPOs come back into the market. We did see, June was the largest month for IPOs, both globally and in the U.S. market. We've seen some large Asia IPOs priced just this week. And so there's, that market has come back. But really the story here has been follow-ons and also convertibles. Convertibles are running at the highest level since the financial crisis, and oftentimes companies are using that as a tool as well to raise capital, particularly with share price movements. And so convertibles and follow-ons have really been the driver here, and certainly something to look at as we continue for the second half of 2020. And then kind of the ultimate market of the quarter, which is overall debt capital markets. And this is the monthly view. We broke every single record possible in the global debt capital markets category, as well as the U.S. corporate bond category, mostly within the investment grade space. But weekly, monthly, quarterly, year-to-date totals have all been shattered. The overall activity for the U.S. corporate bond market exceeded $1 trillion in June, which is the first time that's happened so early. Usually that happens in September, October, if it happens at all. And so, we've already surpassed full year 2019 numbers in that market. And actually, for 2 weeks in April and 2 weeks in May, there were more bond offerings that were brought to market than M&A deals were announced, and that has never happened before. There's really some, there's no precedent for some of the things that have been happening here, particularly with the bond market. And that's really been caused by a number of things. Certainly, issuers that are in need of capital are able to come in, and we saw that with Boeing, which, priced a $25 billion corporate bond offering as the largest deal of the year so far. And obviously, Boeing has a pretty dire need for capital right now, as obviously the business model and obviously the industry is completely being disrupted. But also some very kind of opportunistic activity just due to the way the interest rates are. The Fed obviously stepping in March to lower interest rates, and then also to come in with his bond buying program for both primary and secondary corporate bond offerings, so driving investor demand from the Federal Reserve perspective. We see some very opportunistic companies coming in, like Amazon was able to raise a multi-billion dollar offering, and also get the lowest coupon on record, 0.4%, in the 10-year tenor. But we're seeing kind of obviously treasurers using the ability to tap the corporate bond markets for kind of extending maturities, kind of shoring up balance sheets. Obviously, some companies using the capital obviously to remain kind of in their current business model. And again, that pace won't be able to continue for the rest of the year, but it certainly could foster potential M&A activity and other types of certainly buyouts as well. And so I don't think that the Fed has made any indication that these conditions that we find ourselves in will end anytime soon. And so the big question will be also kind of what these debt levels mean for companies as we go forward. But a really interesting time to be looking at this market as well. Certainly driving a great amount of activity for the DCM franchises around the world.
Thank you, Matt. That is certainly cause for optimism, I think, because if you compare this with the financial crisis, at the heart of the financial crisis in 2008-9, there was a liquidity issue. We had the capital markets basically shut down for even the best of names. But even now, with the lockdown, with people not being able to see each other or go out and get to work, it sounds like capital markets functioned quite nicely, whether it's equity or whether it's debt.
Yeah, I think it's a great point. I think the banks were completely sidelined, obviously, during the financial crisis, and so now to see so much of the creativity that's happening within the market and new structures and new products happening as well. It's really interesting to watch.
Thank you very much, Matt. Let me turn to a few questions that have been coming in. There's one on boutiques. Sounds like it's a very popular topic. So, Lucille, over to you. The question is, what is the explanation behind the apparent resilience in the boutique's share of wallet?
Thanks, Mahmood. I think it's the specialised, more personalised service they offer, which helps them hold on to relationships. They're being hired to advise alongside the big banks. Last year we saw at least one boutique on almost all of the top 10 to 20 M&A deals. So they're holding on to these relationships. But I think perhaps this year it's their ability to adapt. As I mentioned earlier, they don't have the big capital market businesses, the trading businesses to make up for losses on M&A fees. So many are adapting. They're giving restructuring advice, advising how clients can navigate their way through this crisis. Some of them already have prominent restructuring businesses like Houlihan Lokey, but others have adapted. They're smaller and can be more agile. So, for example, Centerview, they adapted. They strengthened their M&A and corporate finance team in Paris to win business from European companies that are, grappling with the economic damage caused by the coronavirus outbreak. So I think it's their adaptability.
Thank you, Lucille. Another question here. This is with respect to the industry divergence that we've seen, and we've heard the audience's sentiment as far as who's going to fare well and who's going to be negatively impacted. So it says deal making in healthcare seems to have ebbed dramatically compared to the first half of 2019, despite being directly related to the pandemic, while there seems to be a resilience in FIG. What do you think of the drivers?
I think I think it's too soon to really see the effect of the crisis on M&A, because I think so many companies are just trying to figure out kind of where they stand and where they want to go from an overall M&A strategy perspective, right? I think it is too soon to see. In 2014 when the kind of the M&A market came back, it was such a strong pop after so many years post financial crisis of really very little activity. It was driven by healthcare. It was driven by just kind of an absolute kind of frenetic pace of assets being swapped, of companies trying to merge, multiple competing bids. I had this flow chart that had all these different healthcare companies and looking at who was buying who and where certain kind of competing bids and certainly other types of activities. It was all driven by healthcare, and I think that we've seen some of that actually even kind of play out even later in the crisis or later in the cycle, where kind of some of those transactions were kind of being unwound or spun off and other things. But I think most companies certainly are evaluating. I think the fact that we are seeing M&A fees kind of decline right now is certainly not an indicator of the work that M&A bankers are probably doing, advising their companies as to what might be options at some point in the future. So I think it doesn't show at this point, and I think you raised it earlier. It will matter how long some of these crises kind of stick around in certain industries, depending on how quickly we see that advice turn into completions and come into our charts. But I think that there is a tremendous amount of activity happening around that space, and from a financials perspective, it's held up well. We have seen some of the largest deals are in the kind of the banking. We saw a large kind of banking a large banking deal in the Middle East announced just recently. Some of the kind of creations of kind of national kind of banking champions potentially. I think there's always been a discussion about how banking consolidation could happen in the U.S. And that's obviously fraught with lots of questions around regulation and things like that. But I think the industry question is a really hard one right now, because what's happening right now is certainly not indicative of what will be happening going forward. And I think there is lots of advice and plans being made as to kind of what would be a great way to kind of improve or enhance businesses through M&A going forward.
Thank you, Matt. I'm glad you brought up regulations. There was a question actually that came in. We've seen governments step in, big stimulus plans, changes sometimes in regulations. Did we see any effect of these changes in regulatory systems or regimes or laws on the activity, and do we see it going forward?
Yeah, I think if we weren't in the middle of this pandemic right now, I think obviously we'd be talking about the presidential election that's coming up soon and how important in the U.S. the regulation and how kind of the views of the administration on M&A can certainly be quite impactful. It was a huge part of the primary process, talking about kind of how M&A would be regulated. Could you roll back M&A transactions? Even with the current administration, there's been a lot of look at some of the technology deals that have happened over over the past number of years, and looking to see kind of how those deals are happening. I think as Lucille indicated, the fear of trade war, the fear of protectionism, the fear of kind of very kind of stringent kind of regulation around M&A is certainly always a fear of the M&A kind of advisory community and companies. You're going to go through this entire 2-year transaction process, and then potentially have it be kind of struck down with a regulatory action, which we saw even with AT&T over the past couple of years. I think it's always something to think about. I think even some of the changes within within China and Hong Kong, and looking at kind of how that might play out, could potentially have an impact on both M&A and also capital markets activity, and how companies are raising capital in Asia Pacific. So it's still a huge factor. And I think there are a lot of unknowns right now, particularly as we head into the election here in the U.S. certainly. But it is certainly something that people will have to grapple with as we as some of the these new deals potentially come out of the post-COVID recovery.
Thank you, Matt. One last question here. It's about valuations. It is, give me a question. How are the valuations behaving during the current situation? And will the suppressed valuation help increase activity in the M&A space?
Yes, and I think we don't have enough really good data at this point to really kind of put the fact that valuations are dropping. But I was running some numbers just to kind of look and see kind of what things are looking like. And I think and very similar to all of the stories this year, the year-over-year comparisons, it looks like the average. The average valuation has dropped a little bit, from all M&A transactions in 2020. But if you look at the monthly, kind of numbers, there has been a pretty sharp decline, and that has rebounded in the last 2 months. And so, as Lucille noted, in looking at deals over $1 billion, June was, there was a spike in June. We do have some more data on June, and we are seeing valuations kind of being a bit bumpy at this point. So we just don't have enough deals to really show, but there are indications that valuations are coming down. And I think, certainly with the private equity activity that we've been seeing and others, I think that will be, we'll probably have some better data as we kind of head towards the end of the year to look at how much that was really just a blip for a couple of the smaller deals that we're able to get through at this point, and as opposed to when we start to really see some consolidation in the sectors. But there definitely is evidence from a monthly perspective that during March, April, May, there was a drop, a pretty considerable drop in the overall valuation models, but that has picked up a little bit, and so we'll see how the rest of the summer compares, and as we get some more data in, we can share those in the third quarter.
Thank you very much, Matt. That's very helpful. I think that brings us to the end of our webinar. So thank you very much to everyone for dialing in today, and thanks to our presenters. Thank you also for the engagement from the audience. We certainly enjoyed your questions. We will be reaching out to everyone following the webinar with slides and the recording, as mentioned at the beginning, and we will get back to you with any questions that we didn't get around to answering. Hopefully, we'll see you on another webinar soon. Thank you very much.